Within business finance, there are some topics that we didn't manage to finish. And that topic is the cost of capital, business valuation. So I'll finish them as part of our revision. Okay. So let's pick up from where we ended. Let me just do the bridging. Let me do the bridging process so that we are all comfortable here. Okay, so we are looking at the area of business finance. So the area that we are looking at in our revision and in our learning too, what we didn't finish is area called business finance. So from our examination point of view, business finance is an important aspect. So business finance is an important aspect of our syllabus. And in business finance, we cover a number of items, okay? We looked at the sources of finance. I'm sure you may remember from your last class that we looked at the concept of sources of finance. Okay, where we said that mainly here we look at the concept of debt and equity. So these are two main items that we spoke about and talked about the advantages and disadvantages of debt and equity. Okay. So we're going to see how our questions can be asked on this particular item on our syllabus. The next item, which is important, is the concept of cost of capital. And if you remember, this is an item that we introduced you to. Okay, that's an item that we introduced you to. And on this particular item, we looked at the cost of equity, how to find the cost of equity, and also how to find the cost of debt. So we're saying that the providers of these finances are basically investors. And these investors expect a return. So all these are investors, and these investors expect a return. So the providers of equity finance, they expect a return. To them, it's a return. To us as a company becomes the cost. And what we learned is that all of us must be able to calculate the cost of equity. And we learned that how can we calculate the cost of equity? To calculate the cost of equity, we say that we have two models that we use. We've got a dividend valuation model. Dividend valuation model, which we call the DVM. Okay. And if we're going to use dividend valuation model, there are two possible possibilities. One, which is rare in the exam, is assuming that we are dealing with a constant dividend. And we're saying that if you are facing a constant dividend, the cost of equity is just a dividend over the share price. Of course, to convert it to a percentage, you multiply by 100. Now we said that the D is the constant dividend. The D stands for the constant dividend. Constant as in year in, year out. So that's your constant dividend. And your share price, your SP stands for X dividend share price. Now it's very important that we take note that this is X div share price. What does X div share price mean? This is a share price after a dividend has been paid. Okay, we indicated that this situation of having a constant dividend may not be as common on your paper. So what we expect is still the dividend valuation model. Is still a dividend valuation model, but this time where we have got a constant growth dividend. Constant growth dividend. Dividend which is growing at a constant rate year in, year out. So this is a more likely situation, and that's a situation which very shortly we shall be going through together. Okay, and what we learned was that if a dividend is growing at a constant rate every year forever, the cost of equity is found as D1 over the share price plus G. The whole thing you multiply by 100. Okay. So now let's look at these parameters. What is D1? D1 is a dividend after 1 year. It's a dividend after 1 year. And that notation stands for the current dividend. So that is your current dividend. And the G is a constant. Annual dividend growth rate. That's what the G is. Okay. Again, the SP is the ex-dividend share price. So on our paper, when the cost of equity comes, it could be that you have to use a dividend valuation model. The alternative to this is a capital asset pricing model, which we'll be discussing at the end, by the end of this lecture. Now, right away, we are going to take a question. We're going to take a question so that we can look at an exam type question on how to find the cost of capital and focusing on the cost of equity. And the cost of equity focusing on what? Dividend valuation model. Okay. So now, if all of you have the questions that has been sent to you, that's the question that I want us to focus on. Okay. I'll be sharing the question on my screen. And let me know if you are able to pick my screen. Are you able to pick my screen?
Yes, we can see it.
Okay, fine. That's okay. So this is the first question that you want to use to practice, but also to learn a number of things. Okay. Here's our discussion as it stands. So the question that we want to look at is this one. Calculate the after-tax weighted average cost of capital. We want to learn what do you use the expression after tax and what is the weighted average cost of capital. This is an average to start with. It's an average cost of capital. An average of what? An average of costs for different sources of finance. Different types of finances that we have. So we get an average. So the thinking is that a company is funded. A company is funded by what? A combination. A company is funded by a combination of funds. Not just one fund, no. A combination or a mix of funds or capitals. That's how a company is funded. What are the predominant funds or capital that we're talking about? Predominantly, mainly, this capital is debt and equity. So predominantly, these are the two types of finance. And the cost of debt is what we discussed in the last time, and we use the notation. The cost of equity is the one that we just started with, and we use the notation. So the cost of equity and the cost of debt. It is this that we are going to average. It's this that we're going to average to find the cost of capital. So in other words, we need to find the cost of debt, cost of equity, and average them. Okay. What type of an average? We're going to use a weighted average. We're going to use a weighted average. So then, when we get a question, it says calculate the after-tax weighted average cost of capital. What is the first thing that you do? The first thing is to ask yourself the question. What are the types of finances that I have? How is my company funded? How is the company funded? Once we identify how the company is funded, then we're going to get the cost of each one of those. And then we do what? We're going to average them. Is that okay? This is the question which has been repeated several times. So that's the question we want to do now. Now, let's go back to our question. How has our company been funded? So that's the first question we're going to address. Once we know how a company has been funded, then we just get the cost of each one and average them. Here is a balance sheet here. If you look at our balance sheet, very clearly, share capital plus reserves is what we call equity. So this question says, please, candidates, can you calculate the cost of equity? Then there's the non-current liabilities, long-term borrowings. We're going to look at the long-term borrowings. Let us now go to question, the details of the question. Let us see the further breakdown that has been given. Let's look at the further breakdown that has been given. They have made a statement there. The share capital of this company includes 12 million of ordinary shares and 5 million of preference shares. This is what we purely call equity. But here we have found another finance called the preference. So we are also going to calculate the cost of the preference. That one. Then long-term borrowings consist of 10 million worth of loan notes. And the 3 million bank loan. So then we have got two types of debt. There's cost of debt for the loan note and the cost of debt for a bank loan. So how many finances do we have then? We have 4. The cost of a loan note, cost of a bank loan, cost of preference shares, and cost of equity. So now we are going to proceed to find the cost of each one of these. And after finding the cost of each one of these, we're going to average them. After averaging them, we're going to get it to make a comment. Is that okay? Are we moving together? Everybody?
Yes, sir.
Okay.
Yes.
So let's move together. We don't want to lose anyone on the way. Okay, we are getting ready for exam, and we know that chances are that we'll answer a question, all of us, on the cost of capital. Chances are that we'll answer a question on the weighted average cost of capital. So as we go through, if any one of us is behind, please let me know so that we can deal with all these issues. Okay. Okay, I've captured it properly now. So let us go step by step. Let's start with the cost of equity. Now, what have we learned about the cost of equity? We have said that we can use dividend valuation model. And we are not surprised here that they have given us the dividends. They have said the ordinary shares of the company having the nominal value is 0.5. Yeah. And an ex-dividend market price is 7.07. And a CAM dividend price of 7.52. The dividend for 20X7 will be paid in the near future. Dividend paid in recent years have been as follows. What does this information emphasize? This information, as you can see, is just talking about dividends. Meaning that to find our cost of equity, what are we going to use? We're going to use the what? Dividend valuation model. Now we have told you that the dividend valuation model has got 2 types. There's one where the dividend is constant. Is our dividend constant here when you can look at this pattern? I'm sure you can clearly say, no, that dividend is not constant, it's growing. It has grown from X3, it's growing, as you can see. This dividend is growing. Okay. So then you put down a formula. You say that, okay, according to my formula, then the cost of equity will be dividend after 1 year over the share price plus the G. No, now what are the dividend? What's the current dividend? The current dividend, we are in 20x7 here. And there's a dividend which will shortly be paid. Now this question was tricky because that dividend was not given, but was given indirectly. They say that the X dividend market price is 7.07. And the CAM dividend is 7.52. The difference between these two is a dividend that was about to be paid. So the dividend which is about to be paid in the near future is 7.52 minus 7.07. Please, can somebody give us the answer?
0.25.
Good.
0.45.
Excellent. So this is the current dividend which is just about to be paid. Lesson number 1. What I want to show you here is how to estimate the G. Now, this estimation of the G is important because you're going to do it a number of times. So how do you estimate the G? The G is estimated as follows. So you say G equals the current dividend, which is 0.45, or I'll say, let's remove the point, say 45, divided by the earliest dividend, which is this one here, which is 37, to the power 1 over how many years? How many years has the dividend grown? Now, normally people make a mistake here. We should not make a mistake ourselves. Let's count the growth. This is number 1, number 2 to here, 2 to here, then 3, and there
4.
4. So this dividend has grown how many times? 4 times.
4 times.
So you come here, you say 1 over 4. Now people normally say, because there's X3, X4, X5, X6, X7, they say it's 5 times. It's not 5 times. The first growth is here. So start counting from here. 1, 2, 3, 4. You don't count that, no. Is that okay? This formula is important in financial management. Then you subtract 1, and then the whole thing you're going to multiply by 100. If anyone is not clear about how to find the growth, let me know. So what is the growth here?
Be 5.02.
5.02. Round it off, you can say it's 5%. Now, your question is, Mr. P, is that in every question you have to calculate this? The answer is no. In some questions, they tell you that we expect a dividend growth of so much. So here we are saying that we are making an assumption that this historical growth is what we're likely to see in the future. So our argument is that in the future, we are likely to see the same historical growth. So some of you say, but is that correct? I agree with you, it's not 100% correct. It's a working model for us to manage to find the G. I want to make sure that everybody is happy with the calculation of the G. I want to make sure that everybody is happy with the calculation of the G. Yes, please.
Yeah, I've failed to find the 5. I'm finding 30% or so.
Take your calculator, 45 divided by 37, then you say to the power. So when you set the power, you must open the bracket, 1/4, and you close the bracket. So you must open the bracket. When you come to this point, put a bracket, you bracket this. So 45 divided by 37 to the power, open bracket, 1/4, close the bracket.
Okay, sir, thank you. I found the answer.
Yes, very important. No, it's very important because you do it only once and then subsequently you'll be all right with it. Okay. Fine. So if G is okay now, let's now conclude our work. If we know the G, let's conclude our work now. Okay. So now you can say everything is over because we are saying our cost of equity equals the D1 over plus G. Multiplied by 100. So let's go. What is our D1? Our D1 is the 45 cents or 0.45 brackets 1 plus 5%. Your share price, you need to use the share price, which is X div, this one, 7.07. The growth rate is your 5%. With all that now, we can say our cost of equity equals 0.45 brackets 1.05 over 7.07 plus 5%. Now look at how I load in the 5%. Look at how I load in the 5%. That's how you load it in. Times 100. So here, is there a common area for mistake here? Yes. It's where instead of putting 0.05, somebody puts in a 5. Here, if somebody puts in a 5 there, here you say, me, I'll put in 5 like that. If you put it in like this, your answer will not be correct. We know that 5%, 5% is 0.05. So that's what you put in. So if you made a mistake, it's because instead of putting 0.05, you put in a 5. So let's go, you multiply 0.45 multiplied by 1.05 divided by 7.07 plus 0.05 times 100. What do you get?
11.68.
Yes. So what is 11.68 code?
To be the cost of equity.
That's the cost of equity. What model have we used?
A dividend
The
growth
cost and
model.
dividend.
Dividend valuation model. where we assume the constant growth. Okay. So we are done with that one. Are we all happy with that one? Let's move to the next one. Let's move to the next one. What is our next one? Cost of reference years. Cost of reference years. The cost of reference years is found as dividend per share divided by market price per share. Dividend per share or market price per share. Now, where is this dividend per share? Where is market price per share? Let's revisit it. It's here. It's here. Look at the information given. A 5% preference shares have a nominal value of 0.5. That's a nominal value, the face value. What does this 5 mean? This 5 determines the rate at which a dividend to be paid. So if you want to pay a dividend here, a preference dividend, or what you call the dividend per share, it's 5% multiplied by the nominal value, and nominal value is 0.5. This is how you find your dividend. So the dividend is VAT applied on the nominal value. The market price per share should be X dividend. So the X dividend market price per share is 0.31. So to do your question, everything is here. Dividend per share is 5% multiplied by 0.5 divided by 0.31, and you multiply this by. That's what we do. Now I'll type this because I need this information. I will need this information. This one. And this one. Okay, so let me remove this. Okay, so let's find the answers now. Let's find the answer, please. So what's the cost of preference? The cost of a preference equals
To be
0.025 divided by 0.31. Somebody has found the answer.
8.06.
Excellent. 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 So this is how our topic develops. So that's the cost of preference. Remember, we calculated the cost of equity 11.68. Now we are there. Okay. Let's move to the loan notes. Remember the concept of the loan note or a bond. Okay. So here we've got the bond. So what are we told about the bond? 7%. What does this mean? 7% is called what? Coupon rate. Nominal value That's the face value of the bond. Under the market price of 102. How do we find the cost? And further, we've been told that annual interest has just been paid. So this is X interest. And the loan notes are redeemable in 4 years. Want somebody to remind us, how do we find the cost of a bond which is redeemable? If a bond is redeemable, how do you find the cost of such a bond?
Use
I
the
use internal rate of return.
Yes. So first of all, you identify the principle or the technique to use. So the technique is internal rate of return. Let's remind ourselves. To get internal rate of return, what do we need? What do we need?
Calculate the NPVs.
We need how many NPVs?
need 2 NPVs.
And also 2 discount rates. 2 NPVs that we call A and B. So that we get 2 NPVs. So we need 2 discount rates called A and B, which will give us 2 NPVs, a positive one and a negative one. And that's exactly what we are going to do. Now, what we are going to do here is fairly repetitive. Once we do it, we'll be doing it again and again, and the format is the same. We're going to arrange the cash flows. We're going to profile the cash flows. From whose point of view are we going to profile the cash flows? We're going to profile these cash flows from the investor's point of view. We're going to profile these cash flows from the investor's point of view. What do we mean by that? Let's see what we mean by that. When is a bond redeemable?
In 4 years' time.
Yeah. Good. This format is fairly standard. Each time we want to find the cost of a redeemable bond, we are going to have year 0. So we are saying we are looking at these cash flows from the investor's point of view, just like what we do in investment appraisal. So let's go. If an investor wants this bond today, he has to pay how much? He has to pay how much?
100.
Okay. And how much interest is he going to receive? Have you seen the interest there? The coupon rate was how much?
7%.
7%. How much tax does this company pay? Opening statement. How much is the tax there?
30%.
Okay. So remember, I told you that we're going to see why the figure we are calculating is called what?
The after tax.
This is after tax because we are going to load in our interest. So our interest is 7% multiplied by $100, giving us $7. Net of tax, 1 minus 30%, which is 7 multiplied by 0.7, giving us how much?
4.9.
This is why the figure that will result is called after tax. Reason, because from the interest, you have removed what? The tax. Okay. So with that now, we can go and say, okay, fine. Let's come here. So your net of tax interest is 4.9. This is what will happen. What will be in the final year? In the final year, the investor is going to receive the redemption amount. What are the conditions of redemption?
5% premium.
Yes. So in the final year, he's going to receive his initial investment at the premium of 5%. So it's 5% on 100. So the amount there is 105.
105.
A premium of 5%. So as an investor, today you buy a bond at 102.34. Next 4 years, there's interest net of tax of 4.9. And in the final year, again, you receive that figure. That's what we do. Now, year 1, year 2, year 3, year 4, there's a constant cash flow 4.9. What do we call a constant cash flow over a period of time in investment appraisal?
An annuity.
It is an annuity. And when we come to discounting an annuity, we discount using the annuity table. And that's exactly what we are going to do now. So somebody out there want them to have an annuity table for us. Okay, so we go, annuity factors, add. Now, calculating the internal rate of return is a trial and error method. It's you who's going to supply the two discount rates. My rule of thumb is that start with a coupon rate of 7%. Start with a coupon rate of 7%. So let's go. Year 1 to 4 at 7%. What's the annuity factor? Somebody to check the tables for us.
Eight,
3.387.
387.
Good. So that is a need factor. You multiply by 4.9, you get that. Year 4 is a loan. Year 4 is not an annuity. It's a standalone figure. So use your present value tables. At 7% in year 4, 0 point?
0.763.
Good. So what is the net position? 5.63. I want to get a positive. What should I do? Should I go up or down? What do we remember?
We need to go down.
You're supposed to go down. We're supposed to go down. How far down you go depends on you. And this is why we say this is a trial and error method. I've settled for 4%. I've settled 4%. So those people helped us. Can you please again help us with the factors?
For the annuity is 3.630. 630.
Okay. And the standalone figure,
0.855.
Excellent. There we are, people. You've done a good job. We found what we're looking for. So now you have your A. The lower discount rate is 4. Your high discount rate, your B, is 7. The positive NPV is and the negative NPV is there. So team, we have everything now. We have everything. So we're now going to calculate the internal rate of return, which is actually the cost of debt. Formula, the internal rate of return, which for this purpose is the cost of debt, is found as you take your A plus your P, then P minus N, then here you multiply B minus A. Okay, so let's go. That is 4 plus over minus plus 5.63 multiplied by 7 minus 4. Can we have the answer, please? Can we have the answer, please?
$5.44.
5 point?
44.
Okay. Anyone seconding this answer?
Yes,
Yes,
5
correct.
point.
Good. Good. So you found the answer, people. So this is the cost of debt. Okay. Let's move tonight. The last item. Our last item is the cost of a bank loan. How do you find the cost of a bank loan? How do you find the cost of a bank loan? If somebody says, please, can you calculate the cost of a bank loan? How do you find it?
Interest multiplied by 1 minus T.
Wow. I'm so happy with people here. So you take your interest rate. And then brackets 1 minus T. Now in this question, they didn't give you an interest rate. Reason? Reason?
Variable.
Interest rate was variable. Meaning that it kept on going up and down. As Bank of Zambia policy rate was increasing, this rate also was going up and down. So now we have got a situation, and those people wrote this exam, they started looking for what? One interest rate. They looked and looked. And if it was in the Zika exam, what would people have said? If it was Zika exam, what would people have said naturally?
The question was wrong.
Yes. There was missing information. Friends, there was no missing information here. There's a theory. The theory says, for such a variable rate loan, use an equivalent. Use an equivalent. So what you do is you use 5.44. So you already have found the answer is 5.44. 5.44. So that is your answer. You get it? And remember that our examiners from time to time, they also model or adapt questions from the FM paper. So who knows, maybe this time around, they will model, they will adapt this one. And you know that if a bank loan has got a variable rate, it means that there is no rate which will be given. So just get an equivalent for a loan which is fixed. So in this case, the equivalent was the loan note, for which we have calculated our 4.44. That's what you are going to use. Is that point clear? Now let me put a warning. What if they had given us a rate? If they said no, the bank loan was carrying a rate of 6%, you would have done what is here. Would have done 6 brackets 1 minus 30%. Is that okay? If they had given you a fixed rate, you would have done this. But if it's variable, you do what we have done here. I hope that point is clear. Otherwise, you may go to the exam now and borrow the cost of the debt of a loan note, saying that's what we did in class. That is wrong. Unless it's variable and no rate has been given. So now, having calculated everything, time has come for us to do an average. The basis for average is here, market value basis. So we're going to get market values of all the items involved. Which items? Equity, preference shares, loan note, and the bank loan. We'll get the market values. Those are the weights that we are going to use. Now this recording is long. So when the recording is long, it can't sit on WhatsApp. It has to go to your YouTube. So please remind me to keep these recordings short.